Welcome to Sectors Up Close. I'm Angeline Ong. Our focus today is on the outlook for the price of gold, and our guest is Saida, Litosh, the lead analyst at Refinitiv Metals Research. Now, the outlook for inflation and Bitcoin's rocky ride has put gold firmly back into focus after a tumultuous 18 months. When the pandemic struck last year, investors fled to safety, pushing gold to $2,000 an ounce in August. But after that, it declined steadily as it became clear the stock market was a better bet. That is until recently, when US inflation data once again sparked an interest in not only this, but other precious metals too. Now, gold is regarded by many, but not all, as a store of value and a hedge against inflation. But this position has been challenged in recent years by the rise of Bitcoin. So what is the outlook for gold and what factors are affecting the price? Let's ask Refinitiv's Saida Litosh. Now, this is a fascinating topic, lots of factors at play here. Let me start with your outlook. What is your prediction on where gold prices are heading, given the current economic and inflation outlook?
Thanks, Angeline. It's nice to be here. So in terms of outlook, I would say that the broader macroeconomic backdrop remains favorable for gold. We believe that gold will continue to benefit from ongoing concerns around economic uncertainty, increased debt levels and negative interest rates, currency stability and building inflationary pressures, given unprecedented levels of stimulus measures introduced by central banks and national governments around the globe. In addition, the ongoing battle against the virus and the risks associated with the development of new variants, vaccines production and distribution will continue to support gold investment demand this year. Having said that, gold could remain vulnerable to further liquidation, especially should we see a faster than expected economic recovery, further rise in US Treasury yields, and the Fed starting to talk about tapering and raising interest rates sooner.
Right, and we saw some of that happen this week. There's also supply and demand as well, those dynamics there. What are the other factors that investors should look out for when it comes to gold prices?
I guess obviously supply-demand dynamics is very important. So I'm going to talk a bit about key demand trends that we expect for the rest of 2021. So overall, gold physical demand is expected to recover this year. If we briefly look at different segments, jewelry sector, which roughly accounts for half of global gold demand, was one of the worst hit segments by the pandemic last year. Demand is expected to rebound this year, driven by post-pandemic recovery, especially in Asia. Retail investment, which is investment demand for bars and coins, is also expected to remain strong, driven by robust demand in key Asian markets. I should also add here, this is a bit of a warning and it's relevant for both segments. A revival in demand is said to be lower than we have previously expected. And this is due to worsening COVID situation in India, which is one of the world's largest gold consumers. With the surge in new cases and fresh lockdowns introduced across many parts of the country, we expect demand to come under significant pressure in the coming months and remain subdued at least until Q3. Another important segment of gold demand has been central bank purchases, which we expect to decline this year compared to last year, as we're likely to see gross sales remain elevated, particularly as nations continue to battle against COVID-19.
But Saida, ETFs are cashing out even as gold prices are rising. Why is that?
So yes, indeed, we saw a strong rebound in retail investment demand on the one hand, which was largely driven by resurgence of demand in Asia as economies continued to recover from the pandemic. There was also an element of opportunistic buying as lower gold prices in many local currencies were seen as a good opportunity to re-enter the market, especially given that the expectations around the price outlook remain on a bullish side. While on the other hand, we witnessed a shift in risk appetite and investor sentiment towards gold among the professional investor community, which pretty much started towards the end of last year and accelerated since the beginning of this year. This was evidenced by liquidation from ETF investors who reduced their global holdings by over 170 tons in the first 3 months. So just to put this into perspective, gold ETFs enjoyed a record amount of net inflows last year at around 900 tons, while Q1 selling represented the second consecutive quarter of net outflows, and it was the largest level of net quarterly outflows since Q4 2013. A shift in sentiment was driven by growing optimism around economic recovery, supported by unprecedented stimulus measures and the ongoing rollout of vaccination programs.
Saida, I want to talk to you about Bitcoin as well, because there's a lot of talk about this being a competing asset to gold. What is your view on Bitcoin versus gold?
So gold still very much remains a robust portfolio diversifier and continues to be viewed as a hedge against inflation and as a safe haven asset. So there are big fundamental differences between gold and cryptocurrencies. The gold market is a lot less volatile and far more liquid. It is well-established and well-regulated market, opposite to cryptocurrencies that are viewed as riskier assets due to the extreme volatility. Another important difference is diverse uses and applications of gold. The highest demand for gold comes from the jewelry industry. About 30% of demand comes from the investment portfolio, and the rest is used in various industrial applications and central bank purchases. So in fact, over the last couple of weeks, we saw gold prices rebound, currently trading at near 4-month high. And this is in the wake of rising inflationary concerns, while the resurgence of COVID across Asia and rising geopolitical tensions in the Middle East boosted safe haven demand for gold. So gold is still pretty much relevant and in the game.
Thank you very much. That was Saida Litosh, lead analyst at Refinitiv Metals Research. Now, before I go, here are some of the top stories in the metals sector. China's cabinet has announced it will strengthen the management of the supply and demand of commodities to stop what it calls unreasonable price increases. China is the world's biggest consumer of commodities, including steel, iron ore and copper, prices of which have soared this year, fueled by post-lockdown recoveries. State TV reported the cabinet, headed by Premier Li Keqiang, decided to step up adjustments in the trade and stockpiling of commodities, reinforcing inspections of both the spot and futures markets and cracking down on what it calls malicious trading in an effort to limit price rises. South Africa's National Union of Mine Workers has asked for a 15% across-the-board wage increase for employees in the gold mining sector. Soaring gold prices have seen earnings by gold miners surge, but the companies have argued above-inflation increases are unrealistic. In a statement, the union said it would respond with, quote, the required militancy. And the union representing workers at Chile's Escondida copper mine said they are getting ready for a lengthy strike if the union and the mine's owner BHP did not reach a deal in looming contract talks. Talks begin in June ahead of the end of the current contract in August. Now, the market will be closely watching talks, which will likely put further pressure on prices already trading near record highs. And that's your roundup of the gold sector. I'm Angeline Ong, and this is Reuters.